Hello and welcome to this session on commodity markets. In this session, you will learn about features of the commodity market, commodity exchanges of the world, types of commodity trades, popular commodity indices, and the regulators that regulate the commodity markets. Let us begin with the basics of commodity markets. A commodity market is a market that trades in primary rather than manufactured products. It is a physical or virtual marketplace for buying, selling, and trading raw or primary products. Commodities traded on the commodity market can be split into two types: hard commodities and soft commodities. The hard commodities are typically natural resources that must be mined or extracted. For example, gold, rubber, oil, etc. Whereas soft commodities generally refer to commodities which are harvested. These include products like wheat, coffee, corn, soybean, etc. Trading on the commodity market can be physical or virtual. Investors can access about 50 major commodity markets worldwide. Increasingly, purely financial transactions outnumber physical trades where goods are delivered. So, which are the top traded commodity classes? The table shown on screen clearly shows a preference for hard commodities such as minerals and petroleum products in the commodities market. Other popular classes include the electrical equipments and machineries. But how did commodity markets come into existence? The first commodity exchange dates back to 17th century Japan. At that time, the samurai were paid in rice, which they then had to exchange for coins through rice brokerages or money changers. It shows that the samurai wanted to have stronger control on the rice market. Establishing a formal market meant the samurai could make more money. So, together with rice brokers, the samurai launched the Dojima Rice Exchange in 1697. The exchange was dissolved 242 years later. Until market prices were posted electronically, chalkboards were used at NYMEX to display the information. The clerk, known as board boys, learned to recognize traders by their voices because they didn't have time to turn around and see who was calling out the orders. Some of the largest commodities exchanges in the world include the Multi Commodity Exchange of India Limited, the NCDEX National Commodity and Derivatives Exchange, the Chicago Board of Trade, the Chicago Mercantile Exchange, the Singapore Commodity Exchange, the Deutsche Börse, and the NYSE LIFE. Commodity derivatives are investment tools that allow investors to have profit from certain items without possessing them. This type of investing dates back to 1848 when the Chicago Board of Trade was established. But this is nothing new. Commodity derivative markets have been in existence for centuries, driven by the efforts of commodity producers, users, and investors to manage their business and financial risk. Commodity derivatives are traded both on the exchange traded markets and over the counter markets. The trades in the exchange traded markets have standard terms and conditions. The contracts in the OTC market are customized to the needs of the buyer and the sellers. Commodity derivative trading allows a person to use a small sum of money for the potential to earn substantial profits. This sort of investment, however, is considered high risk. When prices are not in an investor's favor, he can suffer substantial losses. Moving on to commodity futures. Commodity futures are standardized contracts traded on exchanges. They derive their value from the price of underlying commodity. A snapshot of commodity market here shows various commodities such as gold, silver, copper, platinum, wheat, and rough rice being traded. It is worth noting that all commodities don't settle on a monthly basis. For instance, here the gold future has a settlement date of August while silver has July as its next settlement date. The delivery months are referred to using unique alphabetical codes as shown on the screen. Note that these codes do not correspond to the first letters of each month and instead are an entirely random selection of codes. Hence, a crude oil WTI or West Texas Intermediate future settling in month of August 2015 will have a code of CLQ15 where CL refers to crude oil, Q refers to August and 15 refers to the year 2015. A platinum future settling in month of October 2015 will have a code of PLV15 where PL is platinum, V is October and 15 is the year 2015. Every commodity has a shorter version that is used in a stock exchange. The list of codes across all the underliers available in the market are shown on the screen. Some of the popular symbols are AG for silver, CD for Canadian dollar, CL for crude oil, DM for Deutsche Mark, FZ for germanium phosphate, JY for Japanese yen, KI for gold, and KW for wheat. Similarly, here we have LH for live hogs, PM for Mexican peso, NG for natural gas, NK for Nikkei 225 stock average, O for oats, RR for rough rice, etc. Continuing with the codes, here we have S for soybeans, SP for S&P 500 stock index, XC for corn, XK for NY gold, XT for US Treasury bills, YX for ICE composite index, etc. Moving on to the types of commodity trades. There are two types of commodity trades. First is forwards and second is options. Let us take a closer look at each of these types. So what are forwards? Forwards are an OTC market product traded between two parties where they agree to buy and sell a specific commodity at a pre-agreed price. Here, the trades are agreed bilaterally, that is, the counterparties are known to each other. The trades are customized and terms and conditions are agreed as per each other's requirement. This adds risk to the contract. This is the risk of counterparty defaulting in their obligations or payments. On 1st April, Mr. N enters into a forward contract with Mr. S and agrees to purchase 1000 kg of rice. Let's say the contract expires after 3 months and the spot price of basmati rice is rupees 100 per kg. The risk-free interest rate is say 12%. What should be the price of basmati rice at the expiry of 3 months? The future price is calculated as the spot price multiplied by 1 plus 0.12 divided by 4. In our case, it would be 100 multiplied by 1 plus 0.03, which comes to rupees 103. Now look at the specification in the forward contract. Here, on the agreed forward date, Mr. L will get 1000 kilos of rice and will have to pay price of rupees 1,03,000 to Mr. S in turn. Mr. S will deliver 1000 kg of rice and will receive the money. The risk here for Mr. L is that Mr. X may not deliver the rice as per the agreement. If the price goes up to rupees 110, which means Mr. S will still have to sell it at rupees 103. The risk here for Mr. S is that the price of underlier may decrease to rupees 95, following which Mr. L may not want to fulfill the contract and still buy it at rupees 103 or 103. Moving on to the options. Options give the right but not the obligation to a holder to call or put underlier at a specified strike on specified date. The underliers here are commodities, which gives its value to options contract. They are traded in both OTC as well as exchange traded markets. OTC options are customized, which include the size of the contract, the underlying quality, and so on, while the ones in the exchange traded market are standardized to the terms and conditions set by the exchange. The maximum loss for commodity option buyer is the premium paid. Let us further understand how commodity options work with the help of an example. Let us say on 1st April, Mr. L looks at the gold market and sees the spot market at rupees 23,500 for 10 grams of gold. He wants to buy gold 3 months hence but is not sure if the price will go up or go down. He enters into a commodity option where he can choose to buy gold at an agreed rate. Let's assume it's rupees 23,800 3 months later. He pays a premium to counterparty to purchase this choice. Fast forward 3 months later. If the price is rupees 25,000, he will exercise the contract and he can now buy gold at 23,800, hence paying rupees 1200 lesser. In case the price of gold is rupees 23,000, he will expire the contract as he will not want to buy gold at the agreed upon price of rupees 23,800. Rather, he would buy it at the current market price of rupees 23,000. We have paid an option premium of rupees 500, which we can lose once we expire the option. Let us now talk about two giants in commodity markets. First is gold. It is famed for its safe haven status when negative economic data is released or global markets are slowing down. Especially during recessionary conditions, investors tend to rush to an alternate investment, generally always the precious metal, gold. Gold earned its safe haven status due to the fact that it is a metal and is resistant to monetary policy changes, adding that there always is a healthy demand for the asset. Investors view gold as a warehouse of value and is often used as hedge against inflation. The chart on the screen shows the consumer demand in 2014, sorted by major consuming countries. In that year, India topped list of major gold consuming countries by demanding approximately 843 metric tons of gold for consumption. India is likely to remain the world's biggest gold consumer in 2015 after regaining the top spot from China in 2014, driven by robust jewelry demand, according to World Gold Council (WGC). Second is crude oil, which is the opposite of gold. The price of crude oil may rise on positive economic data, mainly from large participants such as China and US, and tends to fall during a global financial crisis or chain of negative economic data. Another key reason is that the price of oil is published in US dollars, and any positive tendencies in the US will mean a stronger USD, which in turn means cheaper oil for US. This will result in a potential higher import of oil, which drives up prices and demand. The US was by far the largest consumer of crude oil for years, with China a distant second. China overtook the United States as the world's leading importer of crude oil for first time in April 2015, even though the US still leads on per capita consumption of crude oil. Chinese demand for oil is pivotal to crude oil prices. As the number of vehicles have skyrocketed in China, so has the demand for oil in the country. If China's economic outlook is soft, there will be less demand for crude oil, causing the price of crude oil to fall globally. Another main reason for the drop in imports of US is the new technology identified by the US in exploration of shale gas. This has helped US internally mine a larger amount of fuel and hence import less. Besides oil, China consumes a whole lot of other commodities as well. China is also world's largest consumer of steel, iron ore, and coal. As you can see, China has a pretty big hand in commodities market. The impact of China's economic activity and its policy related to strategic reserve holding, trade, and environment are often seen as having a large impact on commodity prices. A slowdown in China is a bad news for commodity-driven countries like Brazil, Russia, South Africa, and so on. If you observe the above graph, the price of gold and US markets are nearly inversely proportionate. As mentioned earlier, when US markets are not doing too well, the investors rush toward investing in the gold and vice versa. The price of oil takes into consideration multiple factors: primary demand, supply, consumption, economic performance of countries, and so on. The second graph is comparison of performance of gold versus Sensex. As you can see, both trend lines are moving in an inverse relation to each other. As mentioned earlier, if the Sensex has a drop or the Indian markets in general don't perform well, investors will withdraw their investments from Indian markets and invest in gold, hence an inverse relation between the two. Let us move on to the commodity indices. Here are few examples of some commodity indices traded via Bloomberg platforms shown on screen. They include Roll Select Commodity, Commodity Spot, Agriculture Spot, and so on. You can also see the last price, change, and percentage of change for each index based on the ticker provided. The most popular indices in world are explained next. Let us look at most popular commodity indices, starting with DJUBS index. The Dow Jones UBS Commodity Index is the index that is composed of commodity future contracts on physical commodities that are traded on US exchanges. This index is based on relative trading activity of individual commodities. In other words, it aims to provide a broadly diversified representation of commodity markets as an asset class. There are various components of DJUBSCI, some of which are aluminium, coffee, copper, corn, cotton, crude oil, gold, heating oil, lean hogs, live cattle, natural gas, nickel, silver, soybeans, soybean oil, sugar, unleaded gasoline, wheat, and zinc. No single commodity may constitute less than 2% of the index, and no related group of commodities, for example, energy, precious metals, livestock, or grains, may constitute more than 33% of the index. The main advantage of DJUBS commodity index are diversification, high liquidity, continuity, economic significance, weighting restriction on individual commodities, and commodity groups promote diversification. On the other hand, the major drawback is that the index is rebalanced annually. losing about 1.5% return compared to the monthly rebalancing. The Continuous Commodity Index or the CCI index measures the price movement of 22 commodities. It has been live since 1957 and was earlier called the CRB index. The weight in Continuous Commodity Index is shown on the screen. You can see that energy stands at 17.64%, grains at 17.64%, livestock at 11.76%, softs is 29.40%, and metal is 23.52%. The major advantage with the CRB index is that it offers a way for investors to trade the CCI index as a commodity future. It also consists of a wide and diversified group of commodities all under one contract. Next we look at S&P GSCI. The S&P and Goldman Sachs Commodity Index can be seen as a benchmark for investment performance in commodity markets. The S&P GSCI represents investments in few commodity futures. The S&P GSCI represents investments in commodity futures which are broadly diversified across the spectrum of commodities. The weight in S&P GSCI is as shown on the screen. It includes 24 commodities in total, where energy stands at 70%, industry metals at 8%, precious metal at 4%, agriculture stands at 13%, and livestock is inclusive of 5%. A major advantage with S&P GSCI is that it provides fair weight based on the trading volume. Finally, the commodity market, like any financial market, is subject to rules and regulation. The commodities market is regulated by the Forwards Market Commission or FMC in India, the Commodity Futures Trading Commission or CFTC in USA, and the European Securities and Markets Authority or ESMA or ESMA in European Union. You now have a brief understanding of commodity markets, trades and indices. With this, we reach the end of this session. Thank you and goodbye.